Tänase seminari teema on meil, räägime kriisidest ja kullast kriisiaegadel. Majanduskriiside puhul on üks ühine omadus neil, et nendest eriti ei kiputa kunagi ette teatama. Et 1929. aastal, vahetult enne kriisi, teatasid nõnda nimetatud Wall Streeti esindajad, et aktsiahinnad on jõudnud pidevalt igaveseks ajaks tõusvale tasandile. Ja rääkimata siis 1995 Mehhikos mõned päevad ennem ei olnud juttugi sellest, et midagi võib juhtuda. 2001 interneti mulli ajal, kui oli interneti mull lõhkenud, siis ka 2 või 3 kuud hiljem öeldi, et mulli pole olnud. Ja 2000 aasta interneti mull oli üheks põhjuseks, miks Krasimir Petrov, üks meie tänane esineja, hakkas huvi tundma maailmas toimunud finantskriiside vastu. Ta luges läbi väga palju artikleid selle kohta ja sai aru, et mõningates kohtades Wall Street ja ametlikud analüütikud võivad väga tõsiselt eksida. Ta kirjutas sellel teemal artikli Iraani naftabörsist ja sellest, kuidas see võib dollarile hingekella lüüa. Seda artiklit on praeguseks tõlgitud 12 või 13 keelde, tsiteeritud mitmeid tuhandeid kordi ja seda artiklit kasutas Ameerika Ühendriikide presidendikandidaat Ron Paul oma valimiskampaania mõnede teeside väljatöötamiseks. Aga kõigest sellest ja mismoodi majanduskriiside ajal ellu jääda, mis nendega kaasneb, räägib Krasimir Petrov ka ise. Hästi lühidalt tema enda kohta. Ta on 7 aastat elanud Ameerika Ühendriikides, ise on ta pärit Bulgaariast ja see, et ta nagu 2 erineva ühiskonna korraga on kokku puutunud, on andnud talle minu arust väga suure eelise, mõistmaks sügavuti maailmas toimuvaid protsesse. Praegusel hetkel loeb ta ennast makroanalüütikuks, kes peab Bulgaarias Ameerika ülikoolis loenguid. Tema kõige suurem pluss on see, et ta on täiesti sõltumatu majandusekspert. Ta ei sõltu pankadest ega teistest finantsinstitutsioonidest. Ja see annab talle vabaduse rääkida seda, kuidas ta maailma ja majandust näeb. Aga anname talle endale sõna, Mr. Krasimir Petrov.
Oh, thank you. You got it? Okay. Oh, thank you very much. My first time here in Estonia. I've been in the US for about roughly 10 years. I came back in Bulgaria in 2004. And ever since I came back in Bulgaria, I've been here about one thing, the Estonian economic miracle. The Estonians did this and did that and the flat tax and all this kind of stuff. And only today, I actually got to see for the first time about, Estonia. You guys are well ahead of Bulgaria. So, all right. So now the topic for today is gold and gold performance during a crisis, something like crisis analysis. The general thesis is fairly straightforward, is that during a crisis, gold prices rise. In other words, the value of gold suddenly rises relative to financial assets, and all financial assets lose value relative to gold. Now, what are the type of crises? Well, you can see, number one, you have political crisis, military crisis, of course, economic crisis, financial, banking, currency, stock market, or crude oil crisis. So I'm going to be covering pretty much all of them today. Basically, just simply provide an example for you to get a flavor of, well, how is really gold performing? What it really did back in history. Well, first of all, these are the crises that I'm going to be looking at over the next 40, 50 minutes. Number one is the Great Depression, then 71, the collapse of Bretton Woods, which is known as the dollar crisis. Then you have the Yom Kippur War, which is the first oil crisis. Then you have the Iranian hostage crisis, 79, which is known as the second oil crisis. Then you have the 1982 Latin American crisis. It actually started in 1981. And 1987 stock market crash. 1993. It is interesting, I'm going to be explaining a little bit, was gold price increased and I could not identify any crisis at that point. I sent on the internet an email to a whole bunch of gold guys and they told me, well, there is no really crisis at that time, but there were inflationary fears. Anyway, at least I'll show you to see the picture what it looks like. 2001, you should be, I assume, familiar with the terrorist Twin Tower attack, which is also known as the 9/11 financial market crisis. You have the Iraq War, and since last year, you have the subprime crisis. So this is essentially the game plan for the next 40 minutes. Well, let's take a look at some of the, well, all of these one at a time. Well, here is a picture of inflation, not necessarily of these same crises, but some of them. You can see Black Monday, that will be 87, stock market crash. You can see in Japanese bust, the SNL crisis, Mexican peso crisis, Asian crisis 1997. You see the LTCM collapse. It was associated with the Russian default. So on the lower side of the chart, you're actually seeing US crisis. And on the upper portion of this chart, you're seeing foreign crisis. So this is what they look like. Of course, it runs up to 2004, so we don't get the subprime crisis here, which will be both US, European, and over time is getting global. Now, Great Depression, one way or another, you've heard, you're probably familiar, started 1929 with a stock market crash. Essentially, what happened at that time was a classic deflationary bust where all prices went down except for the price of gold. So during the Great Depression, at least during the depth of the Great Depression, dollar was fixed to gold. So gold price held steady, and all other prices, real estate, fell approximately 10 times. You guys, or at least we in Bulgaria, have a wild real estate bubble, and real estate prices can easily fall 10 times from their peak. Well, 1990 was Japanese boom. Since then, for the last 18 years, Japanese real estate prices have fallen about 60 to 70%. So they've lost 2/3 of their value. In Bulgaria, there is this belief, it's a blind belief, that real estate prices never fall. Well, they do. Well, in this particular case, gold outperformed real estate 10 times. So if you invested in gold at the peak, meaning right before the crisis, the Great Depression occurred, you invested in gold and invested in real estate, gold would have made you 10 times more money than real estate. Similarly with stock market. Stock market fell anywhere between 15 and 20 times. So from 1929 peak all the way to the 1932 trough, stock market lost 90 to 95% of its value, depending on how you measure it, because there's been some reweighting and the index has been changed. So again, let's summarize here. Stocks, bonds, real estate, and commodity markets all collapsed in prices, and gold outperformed all asset classes roughly by about 10 times, So that's for the Great Depression, 1929, 1932, although it is well accepted that the Great Depression went on and lingered on for another 10 years, roughly until the middle of World War II. So some of the crises that we're going to be looking later on may be short-lived, but there is no problem with a crisis to last easily 10 years. In Japan, the financial crisis, has been running good 17 years and still goes on. All right, 1971. From 1945, the world monetary system was on a dollar standard. In other words, all currencies were convertible to the dollar, and the dollar was convertible to gold. This is known as the Bretton Woods, because it was in Bretton Woods, first established 1945, and it lasted all the way to 1971, when Nixon cut off the dollar from gold. In other words, cutting off dollar from gold simply means that you had $35, you could exchange them for an ounce of gold. Then he said, no, we don't exchange it. We're not going to give gold for paper dollars. In other words, when Nixon had the choice between gold and dollars, he chose gold and he neglected or made the dollar inconvertible. So August 15th, he cuts the convertibility. In between, the London Gold Pool has attempted for a while to manipulate the price of gold. In other words, at that point, there were two-tier markets. There was a standard government price, and then there was a black market or London market gold price, and these two prices started to diverge. Well, there's been a number of bullion banks and governments and central banks tried to manipulate the market, so they tried to manage the price. That's the two-tier market, and gold price rose from 35 to 45 by the end of 71. In other words, as the dollar crisis erupted somewhere in the middle of August 1971, by the end of that year, within 6 months, price of gold rose from 35 to 45, roughly by about 1/3. So that's about 1/3, 30% return, roughly in a matter of a few short months, in half a year. So in this particular case, gold performed admirably, 30% in 6 months. The next one is the first oil crisis. First oil crisis is associated, as I've indicated here, 1973 Arab-Israeli War, known as the Ramadan War, the Yom Kippur War, or also known as the October War. The Israelis had military operations. The U.S. were supporting the Israelis. This did not suit well the Arabs, so they say, we're going to embargo and cut off our oil to the U.S. So suddenly, the U.S. was engulfed in a major oil crisis, the first oil crisis. That's also how it's known, first oil crisis. So crude oil prices roughly quadrupled in a matter of weeks. They went roughly from $4 to $12, but gold prices rose to roughly to 170. So by the end of the crisis, gold-oil ratio went up from 11 to 33. This simply means that if oil went up 4 times, gold went up 12 times. So even though there was a crisis, more importantly, there was a major recession. The recession turned out to be a global recession, so this was one of the first synchronized global recessions, excluding wars, world wars. And during that time, even though oil rose dramatically, gold rose many times over. So a classic example of how one event triggers the rising price of one asset, in this particular case, oil, and gold still goes even higher. But the key here is crisis. People felt uncertainty. People were lining up for gasoline. They didn't know, is it going to last? How long it's going to last? So they fled to gold as a safe haven. Now, this is actually a picture. Some of these concepts I'll be showing you in terms of graphs and pictures. Pictures worth 1,000 words. You can see here, this is not the price of gold. This is the price of oil. So you can see where before the oil crisis erupted, and then you get to see how the price of oil spiked. Roughly from $4 probably to about $12, $13, and you see it's been steady since, and then it has been a second spike up all the way. This is 79, 1980 for the second oil crisis. And let's see also what happened with gold. You can see this is 73. This was the beginning of the crisis. Gold is roughly it's roughly like $40 or so. And you can see at the end of the crisis, it is all the way up to $170. And at some point, a little bit after that, in the aftershocks of the crisis, it went up all the way to $200. So it's a fairly decent performance. You made many times over your money in literally 2 years. 1979 is also known as the energy crisis. It is also known as the 1979 oil crisis. It is also known as the second oil shock. The previous one was simply known as the first oil shock. It is related to pre-Iranian revolution. It had associated with Iranian protests. You had widespread panic. It exacerbated shortages. And 1980 was also the year that Iraq invaded Iran. So this was the year of the Iraq-Iran war that lasted for quite some time. So from this period of the crisis, 79 to 80, gold prices rose from $170 all the way to $850. And we're talking here, if you can see, from mid-1978 to January 1980. So roughly in about 1.5 years, as the crisis erupted and developed, and it was clear that the crisis is not going to go away, gold went up from, what is this, roughly 5-6 times. Oil prices also skyrocketed, and they went from 15 to 40. So oil prices went up almost 3 times, but gold clearly outperformed oil. So the point, it is a general concept in investing and investment analysis that anytime you have a crisis, some assets will rise, but gold will rise even farther, meaning even higher. And this is a second illustration of this basic concept, this basic reality that we observe over and over again. So the U.S. economy falls into a deep recession. Now this is the second example that we're seeing that as an economy slips into a recession and usually is associated with a major hit of the stock market, and in 1979 and 1980 was associated with, especially 1980, rapidly rising interest rates, which meant a collapse of the bond market. So at that period, they had a collapsing real estate market, collapsing stock market, collapsing bond market. At the same time, skyrocketing oil, and gold still did best of all, of all asset classes and of all investments for that particular crisis period. Okay, this is actually what the picture looks like. You see here at the bottom arrow is the beginning of the crisis, and you see at the top arrow is close to the end of the crisis. And you can see again roughly from 200 to roughly 8. Well, the peak was in one day $850. So if we really have to measure it from the beginning to the peak, it was approximately 5 times return. I mean, can you guys actually make 5 times over with real estate in 5 years? I mean, our prices did not increase 5 times in 5 years. Certainly not keeping up even with gold. All right, so the next crisis is actually barely the one crisis ends, and then you have another crisis. The markets all get quiet, everything's fine, everything's dandy for a year, and then in 1981, up until 1982, you have the Latin American crisis. What was the driver? The cause was 1970s were associated with rapidly rising oil prices. So oil exporting countries were flush with money. Back then they used, of course, dollars. And they were also getting paid in gold. It's a different story altogether. So they had excess dollars which they re-lent back to New York banks and London banks, which in turn lent the money to Latin American countries. So during the 70s, Latin American countries were producing, and they were producing a lot of commodities. So they were exported all sorts of commodities. And during the 70s, as commodity prices went, they were able to borrow and to keep paying back. 1980-81 was associated with a collapse in commodity prices. So suddenly everybody realized that Argentina, Brazil, Mexico, and the whole bunch of other countries that borrowed during the previous period could not maintain their payments. In addition, to exacerbate the problem, interest rates had risen so much in 1980 and 1981 that they couldn't even make their interest or the interest on their loans. So suddenly they got in deep trouble. Argentina, Chile, and Uruguay were the first countries to blow up. Skyrocketing interest rates, suddenly you get tight liquidity. Tight liquidity should be familiar from now with the credit crunch. You get also capital flight. We have already in Bulgaria experienced some capital flight. I'm talking about last 2 or 3 months. And suddenly the banking system is beginning to choke on itself. Stock market has collapsed roughly 40% in, I don't know, 6 months or so. So you also get bank runs. Well, we haven't gotten yet one in Bulgaria. I don't know if you guys had gotten it in Estonia, but back then there were bank runs, and therefore you get, 1 or 2 bank runs, and suddenly the economies are engulfed in a banking crisis. And then, of course, currency run. People rush to switch the local currency, which they perceive as insecure and subject to devaluation, for some harder currency. Back then would be, of course, a dollar and gold. So 1982, the crisis that erupted in 81 spread around. It became to be contagion effect, worldwide effects. You also had Mexico defaulted, and this jeopardized the vitality and the survival of New York banks, which had lent heavily to Mexico and other foreign governments. Up until that point, everyone believed that foreign governments will never, ever default. They will always pay. They'll tax their citizens to death, but they will pay up so that, New York bankers can live a rich, lavish lifestyle. Well, Mexicans, they said the heck with Americans, and suddenly American banks were in deep trouble. So bankruptcy fears for major US banks. Well, you see now the second arrow, what happened. This is the peak of the crisis. So over here you see somewhere 81, that's where the crisis begins. And then you see at the top where the prices of gold peaked. So roughly from 3 to 500, roughly, you can see it yourself on the picture. Well, that's a good 60% return in about a year, year and a half. That's one hell of a good return as far as I'm concerned. 60% return is a decent return by any standards when it comes to a year, year and a half. Plus, it's a return in gold, so at least it's considered to be also a safer return anyway. So, what's next? 1987, Black Monday. This is the big stock market crash in US history, the biggest percentage-wise. Stock market fell 15-20%, depending on which indices you measure. Again, during the 1929 stock market crash, the stock market actually crashed on Friday, then it collapsed the second time on Monday, and then on Tuesday, and then later on. So no single day had experienced during the 29 stock market crash as big drop as this particular Black Monday, which was October the 19th, 1987. It was associated with a host of different issues. Number one was weakness of the dollar in the previous year or two. Suddenly, investors were getting scared that there may be another dollar crisis. There have been quite a few so far up to this point since 1971. So dollar crisis got to scare investors. Then they got scared about the stock market having some problems. And then, because everyone was scared and everyone tried to hedge their stock market positions, they used futures and what's called dynamic portfolio hedging to hedge their stock market positions. So they said, okay, I'm going to have the stock market position, and we're going to have futures. And the future is going to offset the stock market. Well, the problem is that when the stock market falls, you got to sell a futures in order to hedge your stock market position. So stock market falls some, they sell futures to hedge. Falling futures drives the stock market lower. Now the lower stock market follows an avalanche of new selling. So it starts feeding on itself in a matter of hours. In a matter of hours. We're not talking about 3 days, 3 weeks. We're talking about market opens and by 12 o'clock everyone is selling. And the more the one falls, the more selling engenders in the other, which feeds back to even more selling in the first. You got to understand, 2-3 hours, total panic. People can't even figure out what the heck is going on. So in that particular day, gold rises that's not correct. In that particular period, gold rises from 340 to 481 as the fears of a repeat of the Black Monday subside. In other words, stock market collapses. Of course, gold reacts, but the next day people aren't okay. They're scared. So it takes them a couple of months to get back in the market, to feel okay, to feel comfortable, and only then gold stops its run on its way up. Let me see if I have a picture here. Well, the picture is that little arrow over there which shows you that particular day. I should have a little more detailed. Okay, here is a little more detailed. So we're looking here from July 86 all the way to December of 87. Now you can see here this particular spike represents that day of the crash. So gold is flat. Suddenly, it skyrockets on the same day. If you actually see, there are rare circumstances where gold will jump that much in one day. I mean, they're visible. You can see there has been some here, there has been some here, but that was a major move. And this now, so what I did was I gave you the 20-year picture, then I zoomed in and showed you a 1.5-year picture, and now I'm zooming in and showing you, 4-5 months. And you see, this particular day is the October 19th, and this was the day of the crisis, a stock market collapse. And you see how gold moved on that particular day from 465 to 485. Again, you got to understand, everybody lost in the stock market 15-20%. And at the same time, those that were in gold were making a fairly good return in that one particular day. So authorities intervened, markets relaxed, but it nevertheless continued to go higher all the way to 500 as people renewed their concern a couple of weeks later that maybe the U.S. economy was not as sound as they originally believed. Now, 1993, as I mentioned, I could not identify. I was looking through the chart and say, okay, let me see if there was a clear movement of the gold price. And on that particular point, in that period, there was a movement. That's a July 1993. As I told you, I sent out an email to a bunch of guys, say, hey, you guys can tell me what anything happened? They say, well, no, we don't remember any particular event. One guy mentioned some other fears with Latin American countries. Another guy said, well, these were fears of inflation. People got scared that inflation will rapidly accelerate. But that will be one example where gold went up and there was no clear, easily identifiable crisis, so at least you can see it. Now, 2001 terrorist attack, you don't need the background. Markets were closed for practically a week. It happened, from what I remember, on Tuesday. That day the markets didn't open. They didn't open on the next day, but only on the Monday after that. And then they started crashing big time once they opened. So gold was at 271. On the very next day, gold skyrocketed in 287. I mean, you got to understand, from a percentage point of view, this is a huge, this is phenomenal move. I mean, have you guys ever seen a stock market move that way, meaning a developed stock market in Japan or US, on, let's say, Frankfurt or Paris? I mean, I've never seen anything like this type of a rally in a single day. And as the crisis subsides in a month, gold price retreats back to 275. Again, the fears were that maybe the terrorists will strike a week later, maybe 2 weeks later, as security was tightened. This, a month and a half later, they said, well, maybe they will not strike again. So now you're seeing the 9/11 picture. The big blue arrow is again pointing to that particular trading day. You see that as September 11 strike, then gold immediately held. It held the next day, and on the next day it fell as people became more comfortable with the fact that probably there aren't any more strikes. In other words, people, and that's more or less a reasonable assumption, that, well, if they didn't strike within a matter of hours or by the next day, probably they're not going to strike 3 days later or 7 days later. Of course, they may strike a month or a year later with a brand new preparation. But as you can see, on that particular crisis day, gold went up big time. Now, this is a different view of the very same picture, the very same presentation, but now you're having, it's called a histogram chart, and see how gold behaved here. And you see on that particular day, I've pointed it here, gold skyrockets. Then it holds, you can actually count the number of days. Roughly, I'm looking at 4 weeks, and only then gold prices subsided as fears of terrorist attack subsided. 2003, characterized by the March 2003 March-Iraq War, also better known as the Second Gulf War, also known as Operation Iraqi Freedom. War ramp-up period. So as the Americans were ramping up, of course, you don't, declare war today and invade tomorrow. I mean, for Iraqis, it was Iraqi invasions, a different story. But the point is that usually, if you're going to be invading a country, it takes 3, 6, sometimes 9 months of preparation, military preparation, all sorts of logistics problems. So as everybody saw that the war is approaching and that the U.S. is militarizing, gold went up from roughly 320 to roughly 380. So this was a significant, by any standards, a significant move. We're talking roughly what? $60 on a 320 basis. So this was a little less than 20%. Again, 20% return in a matter of 3 months is a phenomenal investment or phenomenal return. Of course, it is a return that happened during a crisis, but then again, this is what gold is about. Then, as the war escalated, gold rose further from 330 to 430, and you see we're talking roughly from April 2003 to December 2003. I should have a picture for you, and yes, I do have a picture. The first arrow shows the ramp up of the war itself, and the second arrow actually shows the war as the war progressed, and you can actually see the number is there, 320 all the way to 420 or so. So that's another 30% return. So later on, as the war progressed, maybe 6 months later, maybe 1 year later, it was realized, as we now know, that the war was not a major event. I mean, there were no other nuclear complications. You didn't get Iran involved. There were no other problems with Afghanistan. So after 9 months of war, people realized, okay, it's not going to be any event. I mean, the war, you all know and understand, keeps going on and on and on, even today in the year of 2008. 5 years later, but for us, it's not an event. I mean, just some local war like in, I don't know, Somalia or Sudan. So, again, let's see what else we got. Oh, this is actually the last, which is still going on, which is, I must say more correctly, has barely begun. This is the credit crunch, also, which is a combination of a liquidity crunch and a capital crunch. My safe assumption, is it a safe assumption you're all familiar with the credit crunch and subprime? I mean, I'd assume that you wouldn't need any of that here, but the point is, again, August 9 is when it erupted, and it resulted and still results in financial instability. It's interesting that crisis is exacerbated in November, January, and March, and it is very interesting to notice that as the crisis exacerbated, so next week is dramatically worse than the previous week, suddenly gold moves in tandem with the crisis. So the worse the crisis, the higher the gold went up. And interestingly enough, it's very interesting, in March, crisis is perceived to have subsided with the Bear Stearns fiasco being resolved. At least that's what we're told. So they say, okay, well, the credit crunch is over. We're back to normal, all of this kind of stuff. And gold price falls by $80. Of course, it's also associated with some other manipulation by the gold, which is, elaborated by the Gold Antitrust Action Committee. The guy here is called Bill Murphy. He and GATA at their website, gata.org, have detailed in great scholarly work. A whole bunch of people have done a phenomenal job for better understanding of the whole market, whole gold market, how it works, how it's operated, how governments attempt to manipulate the price, why they manipulate the price. But the bottom line is still this: no matter how hard governments are trying to manipulate and lower and push the price of gold, nevertheless, gold has risen from roughly $250 in 2001 to about $1,000 a month ago. Now it's like 930, 940. So roughly we're talking about 4 times in a matter of 6 or 7 years. Again, this is an outstanding return. So far beaten only by few commodities like uranium, like oil, but it's a different topic I don't want to get into. Point is that since 2001, there haven't been major, terrible crises to make gold outperform the other commodities. But the most important piece is that there hasn't been any major, deep global recession. As there was a global recession in 1973, commodities went up, but gold went up a lot higher. As there has been in 79, 80, again, the same story. Now, as the world is beginning to enter into a global, worldwide recession, the US is already in recession. The EU, at least the Eurozone, is already perceived to be slowing down from 3% to roughly 1%. Japanese economy is slowing down. So as the world global economy slows down dramatically, what you would or should reasonably expect based on lengthy history is that gold will outperform all other commodities. When I'm talking about time frame, the next 2 to 4 years or so. Oh, okay. Well, this is the credit crunch. I actually had a picture. I forgot about it. So you can see that gold has been flat right before the picture. All of these charts are coming from stockcharts.com. So anybody can go to stock charts, log in, and pull up. You just type in the symbol, dollar gold, and you can actually see the price of gold. Of course, you can see other stuff like platinum, etc. But you can clearly see on this picture is that as the crisis erupted on August the 9th, since that day it has been going steadily higher, higher, and higher. Let's see if there's anything else. Oh, conclusion. So conclusion is an excellent hedge during crisis. We have only one, but I don't want to develop the topic in great detail. The Asian crisis in 1997 was the one crisis which the price of gold did not move up. There had been a great explanation for that. First of all, it was not a US crisis. It was not strictly a dollar crisis. But more importantly, these Asian crises were so deep in trouble that they actually had to collect the gold of their own citizens, melt it up, and then sell it on the market to raise cash, to raise hard currency. So, differently stated, gold saved their ass from a much deeper problems. If they hadn't had that gold melted and sold on the market for hard currencies, the Asian countries in 97, 98, we're talking about Malaysia, Thailand, Korea, and Indonesia mostly, they would have been in much, much deeper trouble if they didn't have the gold to sell on the market. At that point, the gold market was weak, and massive selling of gold did not allow for the crisis to lift up the prices. So yes, there have been historically crises where the gold price has not reacted, but it is an exception, and probably that's the only exception that I'm aware of where it didn't happen. Questions? Let's see any questions before we get a break, or we'll see what the boss says. Any questions on the topic?
Can you repeat this address of RT?
Okay, stockcharts.com. Stock. G-A-T-A, known as GATA, G-A-T-A, Gold Antitrust Action Committee, GATA.org. Bill Murphy, that's one of the names. He's one of the better guys in the world who knows the market, who understands it, who writes extensively about it. There's a whole bunch of great people in there. Oh, you're already wireless connected? You're trying to pull it up? Okay. Well, any other questions? Question?
What do you forecast next week after Bernanke makes his announcement? It's perceived that they're going to start the printing presses up. Print more dollar bills next week.
Okay, well, did they ever stop the printing presses at one point? They never did. I mean, they never did. Okay, I am not in the business of trying to forecast next week's gold. For example, I teach macroeconomics, international finance, money and banking, investments. I try to do some investment analysis.
Well, I'm only asking for your educated opinion, that's all.
Again, what I have found is, in general, for currencies, especially for gold and also for stock market, trying to forecast what's going to happen next week, next to impossible job. I mean, I'm using a lot technical analysis personally. I teach roughly 4 to 5 weeks of technical analysis to my investment students at the American University in Bulgaria. So I believe I'm fairly sophisticated in the area, but I've also been investing since 1997, mostly my own money, and I've played the stock market, with options. I've played big time on the futures exchange, and I have learned the lesson that that kind of question is hard. I mean, it's not easy to say next week what's going to happen. Now, it's a lot easier to say and to forecast anywhere between 6 months and 2 years, because the long-term fundamentals take over the short-term randomness of events. I mean, it could be all sorts of different events, but short-term events even out over time, but long-term fundamentals for the dollar are weak. And therefore, gold will be rising up against the dollar. Well, it will certainly be rising up against the euro because the macro fundamentals of the eurozone are weak, but this is a different topic I could discuss after the break.
Ma arvan, et on veel 2 küsimuseks aega ja peale vaheaega tuleb veel temalt teine ettekanne ja selle lõpus saab küsimus esitada, aga palun.
A question about silver and gold correlation.
Okay.
And yeah.
I get these questions. All right, so silver and gold. So what about them? What is the, are they, or what's the question?
They are so
Like twins, all right? Like Siamese, okay? Siamese twins. Yes, they are. Gold and silver are intimately related. I have a fairly decent expertise in silver. I have a decent percentage of my personal portfolio is in silver. The other big chunk is gold. Yes, they are very highly correlated. The most important property to know and understand beforehand is that silver is much more volatile than gold. On the way up, it rises more percentage-wise. Excuse me, on the way down, it falls more percentage-wise. It has very high correlation. It has very solid, strong fundamentals. It has substantial advantages over gold, but it also has major disadvantages. The advantages are related to guaranteed industrial demand. Silver is used for 101 applications, but the disadvantages, number 1, storage. I mean, silver is bulky. Number 2, a little harder to transport from place A to place B. At one point I was telling, I had like 4,000 ounces of silver. It's like 150 kilos. I can't, you know, it's in safe deposit. I can't really take it and lift it. I mean, 150 kilograms is an awful lot. I mean, it's a small box, but it's extremely heavy. So handling causes some problems. And then again, it is always, as far as I'm concerned, nice to diversify. You get a decent chunky gold, but you also get a good percentage in silver. Again, I can discuss some more for portfolio. How to size your portfolio, what percentages in stocks, bonds, gold, real estate, or general commodities. It's a different topic altogether. More questions? Or?
Ja, sellest teemast räägime kuskil peale 10-minutilist vaheaega, aga hetkeks teemegi siis väikese vaheaja ja ütleks, et teine pool ja ettekanne, kuulsin seda eile Rootsis, on mitte vähem huvitav, pigem rohkem. Nii et jääge meiega.
All right.